This is not a drill. Over the weekend, silver prices surged to an extraordinary level, $82 per ounce, a price point that many analysts once considered impossible. No central bank announcement, no emergency press conference. Yet, when markets reopen on Monday, traders around the world will be forced to confront a single question. What just happened to silver, and what happens next? Because this move didn't happen in isolation. It is the result of mounting pressure across commodities, currencies, debt markets, and global supply chains, pressure that has been building for years. And now, silver has become the fault line. To understand why $82 is such a shock, we need context. For decades, silver traded in a relatively narrow range. $20, $30. Occasional spikes, followed by sharp corrections. Silver was volatile, but contained. $82 changes everything. At this level, silver is no longer just a commodity, it becomes a macro event. Margin requirements are triggered. Short positions are forced to cover. Derivatives tied to silver begin to destabilize. In simple terms, a move like this breaks models. And markets hate broken models. Unlike stocks, most futures markets pause over the weekend. That creates a dangerous condition known as a gap risk. When prices move sharply while markets are closed, liquidity disappears, orders pile up, stop losses trigger simultaneously. When trading resumes, prices don't open smoothly, they jump. This is why Monday mornings after weekend shocks are notorious. If silver truly opens near $82, traders holding short positions may have no exit. And forced liquidations don't just affect silver. They spill into equities, currencies, credit markets. Silver is small, but its derivatives footprint is massive. For years, silver has been one of the most heavily shorted commodities on Earth. Bullion banks, hedge funds, market makers, they sold silver they did not physically own. Because silver, unlike gold, was considered controllable. Industrial demand was predictable. Supply was stable. Volatility could be managed. Until it couldn't. At $82, short sellers face exponential losses. Every dollar higher compounds pain. And when losses exceed margin limits, positions are liquidated automatically. No human decision, no discretion, just forced buying. Which pushes prices even higher. This is how squeezes turn violent. Here is where the story becomes dangerous. There are two silver markets, the paper market, futures, ETFs, options, and the physical market, real bars, real ounces. For years, paper silver outnumbered physical silver by enormous multiples. In some estimates, over 100 paper claims existed for every ounce of real silver. That system works only if people don't ask for delivery. But something changed. Industrial buyers, mints, sovereign stockpilers, and inventories began to thin. Is there enough silver to deliver? Solar panels, electric vehicles, medical devices, military technology, and the green energy transition dramatically increased demand. New mines take years to develop. Ore grades are declining. Production costs are rising. At the same time, governments pushed aggressive electrification targets. Demand surged. $82 is not speculation alone. Many investors ask the same question. The answer lies in leverage. When pressure builds, silver breaks first. Historically, silver leads major precious metal moves, not follows them. That's why central banks watch silver quietly, even if they don't admit it. Silver does not trade in isolation, and the dollar is under pressure. When confidence in fiat currencies weakens, hard assets respond. Silver reacts faster than gold because it is both money and industry. At $82, silver is signaling something bigger. Monday's open will reveal everything. 1. Prices stabilize, suggesting weekend exaggeration. 3. Exchanges intervene. History shows that when metals move too fast, intervention follows. If silver holds anywhere near $82, the fallout will not be evenly distributed. Mining companies actually benefit eventually. Why? Highly leveraged hedge funds, bullion banks with naked shorts, ETFs unable to source physical metal. If even one major counterparty fails, contagion becomes possible. In 1980, silver surged under intense pressure. The rally collapsed, but not before damage was done. Today's market is far larger, more interconnected, more leveraged, and the margin for error is smaller. Silver at $82 is not normal. When markets reopen, the first reaction will not be calm analysis, but mechanical stress. Algorithms will scan prices, margin systems will recalculate risk, and exchanges will immediately assess whether trading conditions remain orderly. At $82 an ounce, silver is no longer behaving like a normal commodity, and the systems designed to contain volatility will be pushed to their limits. The opening minutes on Monday will likely be dominated by price gaps, thin liquidity, and forced orders firing simultaneously, creating an environment where price discovery becomes chaotic rather than rational. One of the earliest responses markets may see is intervention by exchanges themselves. Historically, when metals move too fast, exchanges raise margin requirements, sometimes dramatically and sometimes with little warning. Higher margins force traders to post more collateral to maintain positions, and for those already stretched, this often means liquidation. While these actions are framed as stability measures, they have a predictable effect. They disproportionately hurt leveraged participants while favoring large institutions with deep balance sheets. If margin hikes arrive while silver is elevated, volatility could intensify rather than fade. Another tool available to exchanges is the trading halt. Temporary pauses are designed to cool panic, but in practice, they often compress pressure rather than release it. When trading resumes after a halt, the imbalance between buyers and sellers can be even worse than before. In a market like silver, where physical supply is finite and paper exposure is enormous, halts risk amplifying distrust. Traders begin to question whether prices are being managed rather than discovered, and once that suspicion takes hold, confidence becomes difficult to restore. Behind the scenes, exchange-traded funds tied to silver will come under immediate scrutiny. These ETFs promise exposure to silver prices, but their structure depends on authorized participants sourcing metal when shares are created. At $82, the question is no longer price alone but availability. If physical silver cannot be sourced quickly, ETFs face a credibility test. Any sign of delayed delivery, altered settlement terms, or unusual premiums could trigger a rush for exits, turning a pricing issue into a confidence crisis. Bullion banks sit at the center of this storm. For years, they have acted as intermediaries, market makers, and counterparties across the silver ecosystem. Their models assume liquidity, hedging efficiency, and orderly markets. A sustained move above $82 threatens those assumptions. Losses on short exposure grow nonlinearly, and hedges tied to correlated markets may fail to perform as expected. If even one major institution is forced to reduce exposure rapidly, the ripple effects could spread across commodities and into credit markets. Mining companies, often assumed to be immediate beneficiaries of higher silver prices, face a more complex reality. While higher prices improve long-term revenue potential, short-term volatility can be destabilizing. Many miners hedge production, locking in prices far below current levels. Others face rising operational costs, energy expenses, and political risk in mining jurisdictions. Equity markets may struggle to price these companies accurately in the early stages, leading to sharp divergences between metal prices and mining stocks. Beyond precious metals, the silver shock sends signals into the broader equity market. Extreme moves in commodities often coincide with stress elsewhere, particularly in technology and growth stocks sensitive to interest rates and liquidity conditions. If silver's rise is interpreted as a currency warning rather than a supply anomaly, equity investors may reassess risk more broadly. Volatility in metals has historically preceded shifts in stock market sentiment, not followed them. Bond markets will also be watching closely. Silver at $82 challenges the narrative of contained inflation and stable monetary conditions. If investors interpret this move as evidence that real assets are repricing against fiat currencies, yields may rise as bondholders demand greater compensation for inflation risk. Central banks are acutely sensitive to such signals because once expectations shift, they are difficult to reverse without aggressive policy action. Governments, meanwhile, face a delicate balancing act. On one hand, rising commodity prices threaten consumer inflation and political stability. On the other, overt intervention risks undermining market credibility. Strategic stockpiles, regulatory pressure, and behind-the-scenes coordination are tools often used quietly rather than publicly. The absence of official statements does not indicate inaction. It often signals that discussions are happening out of view. History suggests that when silver reaches extremes, the response is rarely confined to silver alone. In past episodes, sudden moves in precious metals coincided with currency adjustments, policy shifts, and structural changes in market rules. Today's financial system is far more interconnected, meaning localized stress can propagate rapidly. What begins as a silver story can become a liquidity story, then a confidence story, and eventually a systemic one. As Monday approaches, traders, institutions, and policymakers face the same uncomfortable reality. Silver at $82 is not just a price, it is a message. It reflects strain in supply chains, leverage in financial markets, and trust in monetary systems. Whether that message is acknowledged or dismissed will shape the days ahead. In the final segment, we will examine the longer-term implications, historical parallels, and what this moment could mean if silver's move proves to be not a spike, but a turning point. As history reminds us, silver has a habit of arriving early to moments of financial truth. In 1980, a surge in silver prices exposed fragilities that regulators and markets had underestimated, leading to abrupt rule changes and lasting damage to confidence. Today's market is vastly larger, more automated, and more interconnected, which means that the same forces now travel faster and strike harder. The comparison is not perfect, but the lesson endures. When silver moves violently, it is rarely an isolated event, and it is almost never meaningless. The modern silver market sits atop layers of leverage that did not exist decades ago. Futures, options, swaps, structured notes, and exchange-traded products create a web of exposure that magnifies every dollar move. At $82, that web tightens. Models calibrated to historical ranges begin to fail, correlations break down, and risk managers are forced to act not because they want to, but because they must. This is how localized price action becomes systemic stress. One possible outcome is stabilization through intervention. Exchanges may continue raising margins, regulators may signal oversight, and large institutions may quietly reduce exposure. In this scenario, silver consolidates below its peak, volatility cools, and markets attempt to absorb the shock without broader fallout. This would not erase the significance of the move. It would simply postpone its consequences. Structural imbalances, once revealed, do not disappear because prices pause. Another outcome is continuation. If physical demand remains strong and paper sellers retreat, prices could remain elevated or even push higher. In this environment, confidence becomes the dominant force. Investors who previously dismissed silver as a niche asset reconsider its role, while institutions reassess assumptions about liquidity and supply. The market narrative shifts from disbelief to explanation and then to acceptance. Historically, this phase is when repricing becomes durable rather than speculative. The most disruptive scenario lies between those extremes. Sudden rule changes, settlement disputes, or delivery issues could fracture trust. If participants begin to question whether contracts will be honored as written, liquidity evaporates. Markets can tolerate losses. They struggle to tolerate uncertainty about the rules themselves. This is the risk that policymakers and exchanges seek most urgently to avoid, because once confidence is lost, it cannot be restored quickly. Beyond price action, silver at $82 forces a broader conversation about inflation and currency credibility. Precious metals have long served as informal referendums on monetary policy. When prices rise sharply, they suggest that market participants are hedging against dilution of purchasing power. Silver's dual role as both industrial input and monetary metal amplifies that signal. It speaks not only to investors, but to manufacturers, governments, and central banks simultaneously. For central banks, the signal is uncomfortable. Official inflation metrics may show moderation, but markets trade expectations, not reports. A surge in silver implies that some participants doubt the durability of current policy frameworks. Central banks can respond with communication, with tightening, or with restraint, but each choice carries trade-offs. Acting too aggressively risks slowing growth. Acting too cautiously risks losing credibility. Silver's move compresses these decisions into a narrower window. Industrial users of silver face their own reckoning. Higher prices raise input costs for solar panels, electronics, and medical equipment. Some of these costs can be passed on, others cannot. Over time, sustained high prices encourage substitution and innovation, but those adjustments take years. In the short term, supply contracts tighten and margins compress. The industrial response to silver AS price will help determine whether demand remains resilient or begins to erode. Investors, meanwhile, confront a different set of questions. Is silver surge a warning or an opportunity? For some, it validates long-held views about undervalued hard assets and over-leveraged financial systems. For others, it raises concerns about chasing momentum late in the move. The divide between hedging and speculation becomes critical. Those entering for protection behave differently from those entering for profit, and markets reflect that distinction over time. Mining equities add another layer of complexity. If silver remains elevated, capital will eventually flow into exploration and development, expanding future supply. But mining is constrained by permitting, environmental considerations, and geopolitical risk. New supply cannot appear overnight, and investors know this. The lag between price signals and production responses is one reason commodity cycles tend to overshoot in both directions. What happens after Monday will shape the narrative for weeks, not days. If markets reopen smoothly and volatility subsides, commentators may declare the episode contained. If stress persists, attention will shift to secondary effects, funding markets, currency volatility, and cross-asset correlations. In either case, silver's move has already accomplished something important. It has forced market participants to re-examine assumptions that had gone largely unchallenged. There is also a psychological dimension that should not be underestimated. Sudden, dramatic price moves alter behavior. They change how risk is perceived and how safety is defined. Assets once considered boring become interesting. Assets once considered safe are questioned. This shift in mindset often marks the early stages of broader market transitions, even if prices themselves fluctuate unpredictably. Ultimately, the significance of silver at $82 lies less in the number itself than in what it represents. It represents strain between supply and demand, between leverage and liquidity, between policy intentions and market perceptions. It represents a reminder that prices are signals and that ignoring them carries consequences. As markets digest this shock, the story of silver will evolve from breaking news into analysis, from surprise into explanation. But the underlying questions will remain. How much leverage is too much? How much confidence is enough? And how quickly can systems built on assumptions adapt when those assumptions are challenged? For now, all eyes turn to the reopening bell. The first trades will not provide all the answers, but they will set the tone. Whether silver's surge proves to be a spike, a squeeze, or the start of a structural repricing, it has already done its job. It has captured attention, exposed vulnerability, and reminded the world that even in an age of algorithms and automation, markets are still driven by trust. This is why silver at $82 matters, not because it happened, but because of what it may reveal next.